First of all, this class is a hybrid class. It's supposed to be done in person. I got a little ill last night and went, oh my God, my first class, I'm gonna have to teach it from Zoom. The rest of them, I'm feeling a little bit better. So the rest of them will be fine. Hold on, so let's get the slides up. Okay, so how's this class organized? First and foremost, this isn't just about personal finance. It's about different aspects of finance and the world of finance, because it's a very rich area to be talking about. And that leads us to the syllabus. And the key words on this page are estimated timing. How far we go on all these things is really dependent on questions and follow-ups and where the students want to go, but it's organized as follows. It's about 2 lectures on the fundamental issues of personal finance, how to think about stocks and bonds, and the difference between the short-term and long-term financial risk. The third lecture is on federal finance, and of course, because of all the issues associated that you hear about with Social Security, I thought I would provide a brief lecture on what is often referred to as the Social Security Trust Fund. And one of the things I like to say, just because they call it a trust fund, it doesn't make it a trust fund. It's like calling a dog a cat. You can call a dog a cat, and Congress can make a rule and say dogs are cats, but it doesn't make it, and you'll find out why. The 2 lectures after that are all about the Federal Reserve and the policies, because that's a core issue associated with interest rates. There's about 2 lectures associated with that. And then finally, we got special topics. I think there's going to be time to do something on exchange rates. I'm not sure there'll be time to do something on derivatives. We'll see. And then the last 2 lectures are really about the instability of the financial system. What makes it unstable? Why is it unstable only occasionally? And when it is unstable only occasionally, it comes at great cost to the economy. And that's not just the US economy, that's every economy. And that leads to the need and the aspects of financial regulations and a variety of financial infrastructure like deposit insurance, and which recently became of great interest because of the failure of Silicon Valley Bank. I happened to be a consultant inside Silicon Valley Bank at the time, and I can tell you as an experienced consultant in this space, they weren't listening to me for sure, but it was pretty amazing just how far they went before the regulators had no choice but to close them down. And you'll find out what the story is when we get there. When you talk about class protocols, I like questions. I have noticed over the various courses I've taught that have been in hybrid that people online seem to be more reluctant to ask questions. And I just encourage you that the process for asking questions when you're taking the course online is you raise your hand through the software. Derek will interrupt me and say there's a question, and I'll take it from there. But I like questions because it helps orient the student, helps me orient various issues closer to what the students want to hear about. My email is arnold@alcopartners.com. Please, if you have any follow-up questions or comments, send them to me. I will respond, and if there's a question there that needs to be taken up, I'll take it up at the subsequent class. Okay. Now I got to get rid of this thing so I can see the slide here. Okay. Where we're starting with, and what we're starting with, is finance axioms. It's one of the things that you learn about in graduate school, the key things to really learn about. What are the assumptions? What's driving this? And you're going to find out that there's 3 of them that we're going to talk about, and then we're going to talk about a variety of the terminologies in that are relevant to just thinking about personal finance and how you think about it. And those issues are the ones listed in the slide. Why discounting is a core construct in finance. What is that really about? Risk and return, insurance, price earnings ratios. What is the underlying math? What is it? Why do the good advisors say it's always good to diversify your investments? What's that really about? And most importantly is understanding the difference between the short term and the long term. There is nothing trivial about time in understanding financial risk. And in particular, we're going to spend a good deal of time on what is called the equity risk premium puzzle, which FYI, economists refer to puzzles when they don't have an answer for what is occurring in the real world. It's a puzzle, and you'll find out what that's all about. And then finally, we'll talk about risk measurement and the time horizon and how that influences how you even think about financial risk. Okay, now it's not working. Let's see if this works. Okay, Derek, my slide, the slide is stuck.
Professor, click on the slide with your mouse and then try again.
Well, okay.
I think when you remove that thing from the...
Oh, okay. Yep,
Yeah.
That's it.
Perfect.
That's it. So one of the things I like to do, those who've taken classes from me on other topics, I really like to work with the data and use the data as the basis, the jumping point for lectures. And what you see in here is a graph of the Dow Jones Industrial Average Index going back to December 2008. And the lines are moving up and down. As everybody knows, the market goes up, the market goes down. But the real question is, how do you think about this as a human being with your own finances? How does one deal with these things? Because there's no question about it. You look at some of these movements, and the movements are huge. In 2008 and 2009, the Dow went down almost 50% in 12 months. It dropped 37% in 1 month at the beginning of the lockdown of the COVID crisis, so on and so forth. And so there are ways to be thinking about this in terms of fundamental finance, and ultimately how you react to it and how you think about it is really about how you feel about it, as you will see as we progress through the course. This other one is one of the things I like to talk about is the difference between these different indices. The NASDAQ it got a high concentration of high tech in it. If you look at it, you go, wow, it's, over time, it's gone up much more than the Dow Jones Industrial Index or the S&P index. Why is that? But look at how much movement there is in that index. What is that about? Well, it turns out as you go through the course, you'll find that this particular graph is completely consistent with the fundamental finance axioms regarding how markets work and how they interpret the issue of risk, which is core. You can't just think about returns. You got to think about the volatility of returns and risk, because we're humans and different people react different ways to what happens when they're sitting on top of a stock portfolio and suddenly it declines by more. In particular, for example, in 1999, the NASDAQ dropped 78%. What do you do in that situation? What do people do in that situation? And how do you think about it? Turning to interest rates, most of the time when I talk about interest rates, I'm going to be talking about three things. One is the black line in the top. That is the Fed funds rate. That is the rate that is literally controlled by certainly is controlled by the Federal Reserve since December 2008. The red line is, I'm using a 10-year Treasury bond. That represents the rate on Treasury bonds. and the difference between the two of them, which is frequently referred to as the yield curve, which is the relationship between short-term rates and long-term rates. And as soon as you just subtract the numbers and graph it, one of the things that you see, and I've got a movie to show you another way to think about this, is when you think about interest rates and what they're supposed to tell you, well, it turns out there's a good deal of volatility in the relationship between long-term rates and short-term rates. And the question is, what does that mean? And how do you think about that in terms of how you might want to invest your own funds? And as an example, I've graphed different yield curves. The reference yield curve is the locus of points that varies by maturity. The maturities here are just separated by name. They're not equal distance. So the 6 month is the same distance from the 3 month as the 10 years from the 7 years. But it's representative of how different these yield curves are, and what do they tell you about? What do they tell you about fundamental finance? What do they tell you about how financial markets work versus how interest rate policy at the Federal Reserve works? So that leads us to this triangle. And this triangle are the three axioms that literally all finance is based on. And the first one is, and they're not terribly controversial, but they're worth thinking about, which is more is preferred to less. It's not terribly dramatic to say in the preference system of human beings, there is this widely held view that more is preferred to less. The other element and the other axiom is now is preferred to later. And the final thing is, in terms of financial instruments, certain returns are preferred to less certain or uncertain returns. And you'll see how these three axioms play out in virtually most of the financial instruments that we'll be looking at and talking about in the course. Derek, is there a way to turn off the videos of other people so I can see the whole slide? Okay, so the first one, yes, we spoil our children and we donate to just causes, but in financial markets, if there is a cheaper way to buy the same financial asset, who wouldn't want to spend less to purchase the same asset? In financial markets, if there is a cheaper way to borrow the same amount of dollars, who wouldn't want to pay less interest? In financial markets, if there's a way to obtain higher returns without additional risk, who wouldn't want higher returns? And in financial markets, if there's a cheaper way to insure against the risk, who wouldn't want to pay less insurance? These, as I said, one could come up with examples and anecdotes of how these don't work out, but in general, this proposition isn't particularly controversial. It's just understanding that it's how we behave as human beings, that this is what is driving how financial markets behave. And one of the reasons is because of this force, and the force is called arbitrage. And what arbitrage means is, if there's a cheaper way to do something, investors, economic agents are going to look for a cheaper way to do something. And that becomes a force for equalization, because gee whiz, if I can buy oranges, they're just as good as Valencia oranges, and I can buy them from Chile, well, I'm going to buy them from, and they're provided at Safeway from Chile, I'm going to buy them from Chile. Well, it also means that in liquid, with the emphasis on the word liquid, which I'll explain in a second, in liquid financial markets, all things being equal, there is this force. And the force is how frequently referred to as demand and supply. But what underlies demand and supply is the concept of equilibrium. And in liquid financial markets, where things are traded by lots and lots of investors, there are equilibrium prices. They get published. You can observe them. You know what they mean. Whereas you get into less liquid markets, one of the classics that most of you are probably aware of is the market for real estate. How much is your home? How much would you get if you decided to sell your home? Well, some people would come over and there'd be a range of bids. It's a fairly liquid market, but it's nowhere near as liquid as buying and selling a stock through a broker, which you can pick up if you got an account, you can pick up the phone and do either transaction. They can quote a price at the time, and that's the price, and you accept the price. You don't think, well, could you negotiate with the market and see if I'm selling the stock, I could get an extra $10 a share on this thing? No, but in less liquid markets, there's more of a negotiation aspect to it. And well, you get some bids. Do you take the highest bid? Maybe you like one of the buyers better than the others. There's all kinds of factors that make it so that the actual equilibrium construct it's a little murky. The idea of demand and supply is still there. For example, in real estate markets right now, one of the things that is happening in the middle of extraordinarily high interest rates, extraordinarily high mortgage rates, one of the reasons housing prices hasn't crashed is because there's a whole bunch of people who got low rate mortgages over the course of the last 10 years, and they're not about to move, given that, gee whiz, if they move, they'd have to take out a new loan with a mortgage rate of 7% or potentially higher, which has limited the supply of homes that are for sale, which has put the homes for sale into more of a bidding war in a very unusual situation. It's affected a lot of the mortgage market and how the mortgage market works because of the lack of volume. Okay. So an example. You can buy a financial asset. We're assuming no transaction cost for the simple example. In market A for $100 per unit, you could instantaneously, in this hypothetical example, sell that asset in a different market, market B, for $101 per unit. Question: how much of that financial asset would you buy? And the answer is, of course, as much as you possibly could. Why? Well, there's no force for equilibrium and changes in prices, and you can buy something at $100 and sell it instantaneously for $101. Well, why not just keep buying it? Well, as a matter of fact, that is something that in fact happens, and that is the nature of arbitrage. An arbitrage in financial markets, looking for assets that are very similar, particularly when you go internationally and you start thinking about buying and selling across country borders. It turns out this is a force for establishing equilibrium prices, because gee whiz, if you just keep buying asset A at $100, won't that increase the price of asset A? And the answer is absolutely. And for example, in the stock market, it's one of the reasons why there are rules and constraints about reporting something when you're trying, for example, trying to take over a company, in terms of how you do it and what the rules are regarding how much of the stock you can own before you have to start reporting what your plan is. So it's a simple example. It's a pretty dumb example, but it's a simple example. But what it does is explain the fundamental concept, which is if you can buy as much as you can you're going to eventually, in a financial markets, you're going to end up driving up the price. I mean, if you look at the trading floors and how the prices are determined on the various trading floors for stocks and bonds and all the rest of them, it's people yelling and screaming at each other based on where they think the price is, where they think the price is going to go. And that is a process in terms of how these financial markets, quote unquote, find and discover on their own what the overall equilibrium price is for whatever it is that they're trading. And there exists, okay, plenty of examples in the national local media. A lot of people in local media, they really don't understand some of the financial principles of finance, and they don't understand how a driving force is in financial markets will pay less to receive $1 tomorrow than they will pay to receive $1 today. And the most notorious example, drives me crazy, is every time they announce the lotto and how much someone has won in the lotto. And they're using what are called gross flow numbers. Yes, but those gross flow numbers are accumulated over time. Now, some of them have said, oh, you know, in a lump sum, oh, you won $2 billion in the lotto, but the lump sum is you only would get a check for 800 million and the IRS would take almost half of it. Some of them actually report that. Well, what is that about? Why is there this difference? Well, it's analogous to a mortgage. So you take out a $1,000 mortgage, and on one of the disclosure reports, they report your gross payment calculations associated with that mortgage over the maturity of the mortgage. And it's way bigger between the principal payments and the interest payments accumulated. It is way bigger than that. What is that all about? And the answer is that's all about discounting. And why it is, what discounting gets into a lot of mathematical formulas, and I'll show you a couple of them in terms of how you think about them. But what is that about? Well, one of the things that financial markets do is they translate future flows, future occurrences into a current value. And what is underlying that translation is the English sentence, now is preferred to later. That getting $1 a year from now is not worth $1. Getting $1 2 years from now is not worth getting $1 1 year from now. And that is all about discounting. And that discounting is the mechanism throughout all financial systems of translating the difference between flows and stocks, i.e., it's the difference between earnings and price, which is fundamental of mixing two completely different concepts in one ratio called the price-earnings ratio, which is frequently referred to as some guide to short-term trading, and I'll show you it isn't eventually, but not right now. So what is discounting, and what is discounting really about? How much would you pay to receive $1 a year from now? If you're a normal human being, you're not going to pay $1. You're going to pay something less than $1. In the simple example, I said, let's assume you'd pay 95 cents to receive that dollar in a year. Well, that leads to this really simple example of equating 95 cents to the dollar, which is the one, and, well, you are discounting, and that involves the ratio 1 plus R, and you can calculate that. You can use Excel spreadsheets. You can do all kinds of formulas. But it turns out discounting is the basis for interest rates. That is what interest rates are all about. It is all about the translation of receipt or payment of dollars in the future versus what is that worth today. And I put a little box in there if someone wants to play around with the math to make sure that I got it right. You know, discounting at 5.26% will get you to 95 cents. If we use a higher interest rate, it would lead to a lower number. If we used a lower interest rate, it would lead to a higher number. And this is the example having to do with the lotto. This isn't that recent of one, but it's the same idea, which is, what is, in this particular example, what is the interest rate that California lottery management is using when they say, oh, you have an option. You don't have to take the equal payout over 20 years. You can take a lump sum. Well, they come up with a number. Well, there are rules regarding what numbers for annual payouts over 29 years. And the one I used in this example was just to keep it consistent, was 5.26%. But that is no different than the loan. It is used throughout finance, all kinds of things, and it is the basis for thinking about what is the Fed doing and how does it interpret the yield curve, because sitting in the yield curve are instruments of different maturities, which means implied is a market that is finding equilibrium interest rates over time, over different, when I say time in that situation, different maturities. And what that means is the market is coming up with implied discount rates associated with each of those time periods that really are its reflection through all kinds of trading, billions and billions of dollars going back and forth between different traders, different brokers, that you name it. But it is the market saying, okay, this is what is par value at this particular moment. And based on that, one can calculate, okay, if that's what they're saying, a coupon bond of 5% for 10 years, its value today is X. What is the implied discount rate? One can come up with a calculation following some financial math. And that leads to this. This is financial math, but it's really about humans. And what it says is, okay, the lotto's value winner in billions of dollars in terms of lump sum is sensitive to the interest rate used for the discounting purposes. And as you lower the interest rate for purposes of discounting, it will get more value. Well, it turns out this structure, if you have some kind of portfolio of bonds and you want to know every month they report on the value of those bonds at the end of the month, they're taking the interest rates that are in the marketplace and they are discounting the cash flows associated with those interest rates to convert those cash flows into a single number. And that is what discounting is all about. It's taking a whole bunch of other numbers that are occurring in the future and applying fundamental financial principles to those future cash flows and saying, okay, if I want to sell this now, what is it worth? That's the difference between value and flows. And in financial markets, it comes up all the time in terms of how it plays out, as you'll see as we go into a couple of different markets. Okay. In financial markets, higher returns are expected for uncertain payments. What that really means is you have to be compensated to take on more risk. Why take on more risk if you don't need to? So therefore, there has to be some compensation. And at the same time, you will pay to reduce the uncertainty associated with unexpected, undesirable events. And the classic example, which most homeowners have, assuming they can still get fire insurance in the state of California, is fire insurance. What is that about? That is called event risk. Event risk is something you don't control, gets out of hand, whatever, and you don't want to have to pay out of pocket to rebuild your house and associated with the fire, and you are willing to pay out money over time through insurance premiums to limit your downside loss should the event occur. Now, I'm 70 years old. I've been a homeowner. My wife and I have been a homeowner since 1982. And one could accumulate that premium over time. It's, it's a very large number. We've never had a single fire, not once, nor do we want one. And we are continuing, and we will continue to pay fire insurance. And what is that about? Oh, because I know what the premium is. I'm paying the premium every month. I get the bill from State Farm Insurance Company every month, and it gets paid every month and has been getting paid every month. And I would prefer to have that known payment rather than the uncertainty associated with what happens if a fire occurs and the potential losses that we might incur if a fire occurs. Even though we haven't experienced one, the odds of us having a fire are actually pretty low. But that is a statement about what us humans do, how we behave in terms of how these markets work. And it gets to the underlying principle. We are willing to pay to reduce our financial exposures, which is completely consistent with the same concept of being compensated for taking on more risk. We're willing to pay to reduce risk. They're very much of the same thing playing out. In terms, another example is the difference between leasing and buying a car. And yes, there are differences in the transactions and so forth. But fundamentally, leasing and buying a car, if you look at the cash flows in terms of what you are paying and when you are paying it, it is a present value calculation. With leasing a car, yes, you get a newer car, but at the end of the lease, you're returning the car. Whereas if you buy a car, you can own the car for a much longer period. So the point of that is it is directly an application of present value discounting cash flows over time. And that's how the auto company, they jigger it a lot depending on the kind of car and what they can get. But one of the reasons why they do it is because the out-of-pocket cost for leasing a car up front, what you have to put down in cash is a lot less than what you have to put down for purposes of buying a car. And similarly, the other famous example up there is reverse mortgages beside home equity loans. They're operating on the same principles. It is about cash flows and what those values are. And reverse mortgages, you receive monthly payments against the equity in the home, and you're giving up the present value of the payments when the house is sold when you pass. With a home equity loan, you're receiving funds to borrow against the equity, but you pay them off, you borrow them over time. It's just looking at the cash flows and the timing of the cash flows and the present value of the cash flows and the structuring it. And what it really gets to is about financial structure. When you really get it in terms of what finance, a lot of what's called financial engineering is about, is rearranging the timing of cash flows. And the difference between a reverse mortgage and a home equity loan in terms of how it plays out from a financial perspective, the financial transactions are very similar from a standpoint of present value, and because there are enough people out there offering reverse mortgages and home equity loans, but they're structured very differently as to when you pay, when you receive, all of those things. But all of that stuff comes down to the same basic equation. It's about discounting those cash flows over time to the present. So what is the other proposition that we hear about? Don't put all your eggs in one basket. And what is that really about? It is about insurance. It is about the risk return framework that underlies all financial markets. And I have a really dumb example. And when I do this in class, I can take hands. It's going to be a little bit tricky to do it in Zoom space. So you can consider two different investments held for 5 years, each promising the same rate of return over the period after investing $100, but they're subject to market fluctuations. And investment A is the black line on the left and goes up and down, ends up in one place, and I can't see the one on the right, but I believe it ends up in the same place, but it moves up and down, but it moves up and down differently. So where does the adage, don't put all your eggs in one basket, come from? And what about this investment? Well, investment C has the same return over the 5 years as investment A, the same return as investment B, but the line, it doesn't go up and down as much. And so the question, if we could do the survey, is what would be the vote of the class in terms of would they prefer investment A? Would they prefer investment B? Or would they prefer investment C? Because they all end up at the same place. The only difference between them is the wiggles. So I've taken the vote, and it turns out everyone picked investment C, hoping that's in fact what you really think. And there's a reason for that. And it turns out investment C was constructed as half of investment A and half of investment B. It was just in the simple example that I constructed for the class, it is literally saying, hey, I get the same return, and with a lot less wiggles if I just separated my eggs into each investment equally. As I said, it's a really simple principle, but you can apply it to financial assets. Good financial advisors will tell you every time, diversify, diversify, diversify. And the reason is because the risk of concentrated investments are potentially significant. They can go up a lot. They can also go down a lot. And gee whiz, most people, they're happier if they have something that, just generally keeps going up. Maybe it doesn't go up all the time, but just generally goes up, as opposed to going way up and way down in terms of how we react to these investments. And that feeling of it is a preference, and it is a preference expressed via financial markets. And it is that preference system that is the basis for risk and return. You prefer less risk to more financial risk. When investment opportunities arise, they occur prospectively. They always involve some uncertainty. You don't, especially a group in this age cohort, you have learned you just don't know what's going to happen. There is uncertainty with outcomes. There is therefore financial risk, and the whole thing is about how do you manage it. And one of the ways to manage it is you diversify, because you don't really know what's going to happen. And by diversifying, you reduce your risk just by diversifying into lots of different assets of different kinds, because there's correlations out there. You can't predict them. You don't know exactly what's going to happen. And diversification reduces the risks of your financial investments. And it is why the statement, don't put all your eggs in one basket, is a robust, it's just a robust conclusion. And here is an example using, we're going to build the risk and return framework. So it's a graph. On the x-axis is your expected return. On the y-axis is this word called risk. We're not going to get into exactly how do you measure risk. It can get really hairy. Don't let anybody tell you measuring risk is simple. It isn't. But here's an example. And I have plotted 4 dots. Investment A, investment C, investment B, investment D. Now, which point represents an equivalent return to investment A, B, D, or C? Just in this really simple example, what represents an equivalent return? And we know from just English and human preferences, well, A is preferred to point B. Why? Well, you're getting the same return for less risk. Why would you prefer B? Okay, well, what about C? Well, C is preferred to point A because more is preferred to less, and you're not taking on any additional risk. So the conclusion is only point D is equivalent to A in terms of what is called a preference curve. And we don't worry about the exactness of this in the simple example, but this is the basis for Harry Markowitz's risk return curve, for which he got a Nobel Prize decades ago in economics. And what it says is that you have risk avoiders, you have risk lovers. Sure, there's always things that depart from and individuals that depart from the, some people like, quote unquote, playing the market. They like gambling on high risk ventures because there might be an opportunity for them to make a huge return, even though there's also some opportunity for them to lose all of their money. And what it really gets down to is this is the basis for the risk return diagram to say that from a standpoint of preferences and social preferences, A and D in this particular diagram are equivalent. And that leads to the more common one that you see in financial textbooks, Finance 101 textbooks, an equilibrium risk and return regarding what is the market giving you on a particular day, where on the lower left-hand side, they call it the risk-free rate. People ask, well, what is the risk-free rate? And we all default to the 3-month treasury rate from a standpoint of a risk-free rate. There's virtually no risk that you won't get your money back. And so that represents the safest kind of investment. But to increase your returns over time, you have to take on greater risk. And markets reflect this in terms of how they price things, how they price bonds, how they price securities, how they price all financial instruments. And here's some examples. What I have graphed here is the difference between the 10-year treasury rate, which is the black line that goes almost through December 2023, and a Moody's AAA. Moody's AAA are the safest corporate bonds that are out there. Don't get me started on how they blew it in 2007 and 2008, but nevertheless, you can see, well, what do you know? If you're willing to take on some of the credit risk associated with corporate AAA bonds, you will earn, at least based on the market, you will be paid a higher interest rate than you will just investing in 10-year treasuries. What's interesting is the difference between those two curves, which is the purple line in the lower graph. And the reason why it's particularly interesting is because the volatility of the spread between the red line and the black line, that it moves up and down, tells you something about financial markets, which is they change their mind about risk a lot and frequently, no matter how and where you measure it. Because if it were constant, if the risks were well known and understood, if it were constant, that purple line should be relatively steady. And it's not. And that tells you something about financial markets. Anybody who thinks financial markets have one particular point of view and they just have that point of view and hold that point of view for long periods of time, forget it. The markets change their minds constantly, and it is reflected in the volatility, not of just interest rates. It is reflected in the volatility of the difference between different interest rates, which have different risks. And it is, you go on to into the major investment banks, they have trading floors of people trading these things, betting on these things. They've got all kinds of infrastructure and screens, just like what you've seen in the movies, infrastructure and screens, yelling and screaming at each other in terms of what they're doing. This is part of the process through which the financial markets come to an equilibrium every particular minute of the day for highly traded instruments. And yes, and in that process, the market is reflecting constant change, and it is part of financial markets. Here's another one. I pulled out Moody's BAA, which are higher credit risk than the Moody's AAA, just show you how much these things can move. The rate difference in this particular case, just between two different ratings of muni bonds, look at that difference. Well, if you're a trader and you make money on market moves, there are traders out there that are called spread traders. They're not just buying one bond, they're buying one bond and shorting the other bond, betting on the nature of a particular spread. And one of the things that you see in here is, well, what do you know? If you just lay over that graph with the gray areas of recessions, look at how much that credit spread, as soon as the recession hits, one of the things that happens in the marketplace is the risks associated with recessions regarding whether or not, what credit means, will you get paid back, or will the bonds that you purchase, will they default on those bonds? That is what the market, and that's how much the market changed its mind. And look at how it reversed itself as you came to the end of the recession. Look at what happened during the COVID crisis in early 2020 in terms of how much markets move. And if you bet the right way on that particular spread, you make a lot of money. if you bet the wrong way, you'll lose a lot of money. And that's why it takes traders who have all this infrastructure. There's all kinds of infrastructure to prevent them from trading, taking too large a bet. That's another story entirely. But the real point is what this is a reflection of how the market's assessment of risk increases when the economy is in a recession, because in the real world, there's no question about in a recession, more businesses go out of business, more bond payers will not be able to pay the bond and they default on the bond. And you think maybe these things aren't volatile. One of the things that I've done here is just graph the daily percentage change in the S&P 500 versus the daily percentage change in the credit spreads. You know, the credit spreads, if you go to CNBC, you'll see them, on Bloomberg, you'll see them, and that kind of thing. But all you have to do is look at the data and look at the lines and say, holy cow, the prices on these things on a percentage basis, they're changing a lot, and they're changing a lot every day. And what that is telling you isn't just about risk, it is telling you about markets. And one of the things that markets do is they make up their mind every single day that these things are traded regarding how much they're worth. And if they're so smart, how come it is that they keep changing their minds every day regarding what's going on? And this includes, in this particular graph in the blue line, this includes the S&P 500, which is a broad index of stocks, versus a percentage change in the credit spread from the prior two graphs. So the lesson learned about this is how markets work. This is how they've always worked. This is how they're always going to work. And ultimately, we're going to have a conversation about predictability in terms of what does that mean? And as you start thinking about looking at these lines, you're looking at very short-term movements in these values. What does it mean to look at them over a much longer term frame? We'll be talking about that, but time, obviously, in terms of how you think about risk, time is a critical variable. It's very easy to put the prices in there over one day. You just grab the prices from a reporting source and graph them and look at the percentage changes. But as soon as you start doing it over time, things start looking a little bit different, as you'll see later in this course. And this is an index. When I said earlier, there's nothing trivial about measuring financial risks. There's a variety of measures out there. The one I use it's called the Black-Scholes measure of volatility, and the reason is because it accounts for trends. And when you just graph how volatile is the stock market, this is taking, again, I think this is the S&P 500, and looking at the volatility in the series, you see a great deal of volatility and occasionally a huge increase in its volatility. And look at what those time frames were. The biggest increases. This is straight data. I'm doing nothing fancy other than getting the daily data from yahoo.com, downloading it, and doing the calculations for the volatility. October 87. That's the famous one in 1987, where the market dropped. September 2008, when the market, this is the Lehman Brothers bankruptcy, and the market dropped a huge amount. And when we went into the COVID crisis and the kind of volatility one saw in April 2008. So what this tells you is events are going to occur that we cannot predict. There is no way to predict, but there are events that are going to occur in the time frame in which you're making financial investment decisions, of which the market reacts in a huge fashion, and in particular of these three occurrences, in a very, very negative fashion, which means the market dropped by a lot on each of those three time periods. And anybody thinks you could have predicted it, well, you could have guessed, but you couldn't have predicted it. Okay, we were at 2 o'clock. We like to take roughly about a 10-minute break, so we'll come back at 10 after 2. And I would encourage anyone who's got any questions of what we've talked about so far, that's a really good time. Before we start the next part of the lecture, that's a really good time to ask those questions. So if you have any, now's the time. So I'll see you. It's actually 12 minutes, but that's okay. I'll see you at 10 after 2, if that works for everybody. Derek, are you online?
I am.
Good. There's images of people taking the class on the right-hand side, and I can't see all my slide because of those. Do you have a way of shutting them off?
Yes, there's up at the top of that window. There's like just
oh, it's up to me.
Yep.
And what do I do?
Click on that single dash, and it should shrink the whole thing.
Single dash.
Just up at the top, you should have like a single dash.
Thank you.
And then you can drag that bar anywhere off of your screen.
Oh, thank you.
You're welcome.
See you in 10 minutes.
See you in 10 minutes.